You open your banking app and see more money than you have seen in a long time. The bills are covered. The next paycheck is already on the way. Nothing is late, and somehow you still feel nervous. You check the balance again before buying something small. You imagine the car making a strange sound. You wonder what bill you forgot. You look at money that is supposed to make you feel safe and think, why am I still scared? Because a bank balance can change faster than your financial memory. The money may be new, but the fear remembers every time you thought you were finally okay and life proved otherwise. That is the hidden difference between having money in the account and trusting the system around it. One is a number you can see today. The other is the belief that your progress will still be there after a normal month, a bad week, or one expensive surprise. When you have lived close to the edge, money never feels like it is simply sitting there. It feels like it is waiting to be claimed. Part of it belongs to the next rent payment. Part belongs to the car, even though the car has not broken yet. Part belongs to a family problem that has not happened. So you can have $5,000 saved and emotionally experience it as money already under attack. The balance says you have money. Your mind says several future emergencies are competing for it. That is why saving your first serious amount can create a strange contradiction. You expected relief. Instead, you became more aware of everything that could take it away. When there was almost nothing in the account, the problem was obvious. You are trying to make it to payday. Once the number starts growing, the fear changes. Now you are trying not to go backward. You are afraid of returning to the version of life where every surprise became debt, and one bad month erased 6 good ones. Being broke teaches your brain a sequence. Money arrives, pressure goes quiet, something happens, the money disappears, then you restart. If that sequence repeats often enough, your mind stops treating a higher balance as safety. It treats it as the calm part before the next reset. This is financial memory, not a lack of gratitude, not proof that you are bad with money. It is the expectation that the past will repeat because, for a long time, it did. The Federal Reserve's latest household survey found that 59% of adults had at least one major unexpected expense during the previous year. Vehicle repairs, home or appliance problems, and medical costs were among the most common. What people call unexpected is often normal life arriving without a reserved category. So the mistake is not feeling cautious. The mistake is asking one pile of money to protect you from every possible problem. When all savings sits in one account with no clear job, every expense feels like a threat to the whole system. A car repair does not feel like a car repair. It feels like losing your emergency fund. An annual insurance payment does not feel planned. It feels like proof that you cannot keep money. A necessary purchase does not feel affordable, even when the money exists. It feels like the beginning of another slide backward. The account is doing too many emotional jobs at once. It is your emergency fund, home deposit, retirement backup, repair fund, family support fund, and proof that you are no longer struggling. No balance can feel safe when every dollar has 6 responsibilities. This is why 2 people can have the same amount saved and experience it differently. One sees $10,000 and thinks, I have options. The other thinks, that will disappear quickly if life turns. The difference is not always personality. Sometimes one person has a system that tells them what the money is for, while the other has a number with no protection around it. The Consumer Financial Protection Bureau describes financial well-being as more than paying bills. It includes control over month-to-month finances, the ability to absorb a shock, progress toward goals, and enough freedom to make choices. Safety is not just possession, it is control, resilience, direction, and permission. That explains why a larger balance does not automatically create peace. You can have money and still have no clear answer to 4 questions. What is safe to spend? What must not be touched? Which future costs are already covered? What happens after something goes wrong? Without those answers, every financial decision becomes a private debate. You can afford dinner, but feel guilty during it. You can replace the worn-out laptop, but delay until it becomes an emergency. You can begin investing, but moving money away from cash feels dangerous. Fear begins protecting the balance so aggressively that the money stops improving your life. And that is the real cost. Financial anxiety does not only make people overspend, it can also make them hold too tightly, delay useful decisions, avoid investing, and treat every ordinary expense as failure. The account grows, but confidence does not. You become better at accumulating money without becoming better at trusting yourself with it. Even milestones can feel empty. You reach 1,000, then decide safety begins at 3,000. You reach 3, then decide it begins at 10. You reach 10, then calculate how quickly a job loss or medical problem could consume it. The target keeps moving because the target was never only a number. You were trying to buy certainty. Money can reduce risk. It cannot remove every possibility. The Federal Reserve found that 63% of adults said they could cover a $400 emergency using cash or its equivalent, but only 55% had savings equal to 3 months of expenses. Covering one problem is not the same as trusting that your life can absorb a longer disruption. This is also why income alone does not settle the fear. A person earning more can still feel unsafe if every raise creates a larger apartment, newer car, higher obligations, and more people depending on them. The balance rises, but so does the amount required to keep life standing. From the outside, that person may look successful. Inside, they know one interruption could expose how much depends on the next paycheck arriving on time. Status can make someone look secure while increasing the cost of staying secure. Real safety is quieter. It is knowing which part of your money handles emergencies, which part handles ordinary life, and which part keeps building the future. The reframe is simple. Safety is not the moment your balance becomes impressive. Safety is the repeated proof that normal life can happen without erasing your progress. That proof begins by giving your money separate jobs. Keep this month's spending separate from the money protecting you from disruption. Then create categories for costs that are predictable but irregular. Car maintenance, annual fees, medical expenses, home repairs, gifts, or whatever repeatedly appears in your life. This matters because a tire replacement should not compete with job loss protection. When the tire money already exists, the expense is still annoying, but it no longer tells your mind that the entire system is failing. Next, build 2 different buffers. The first is a small check-in buffer that absorbs timing mistakes, slightly higher bills, or a week that costs more than expected. The second is the true emergency fund for events that interrupt income or create a serious shock. A check-in buffer protects the month. An emergency fund protects the larger plan. When those jobs are separated, you stop opening your emergency savings every time ordinary life becomes imperfect. Then define a protected floor. Choose the amount you do not casually spend, and decide what happens above it before the balance grows. Some excess may go to investing, some may go toward a home, debt reduction, or another goal. Some can fund planned enjoyment without guilt. This gives you something anxiety rarely provides: permission. You no longer have to ask whether every dollar should be saved forever. You already know which dollars protect you and which are available to improve your life. Finally, measure consistency. Not only the highest balance you have reached, track how many months you covered your real expenses without using debt. Notice when an annual bill arrives and the correct category pays it. Notice when you use part of a buffer and rebuild it without panic. Notice when an emergency costs money but does not become a financial identity crisis. Those moments are evidence. A single large deposit can raise your balance. Repeated months of control teach your mind that the system works. That is how financial trust is built. Not through never spending, not through reaching a number so large that nothing can touch you, through seeing again and again that money can leave for the right reason without taking your stability with it. You are not failing because your emotions have not caught up with your account. You may be learning safety after years of learning survival. Your mind became alert because being careless was expensive. It learned to scan for the next problem because the next problem often mattered. The goal is not to shame that fear out of you. The goal is to give it better evidence, clear categories, protected buffers, a defined floor, repeated months where life happens and you do not restart. Eventually, the balance will stop feeling like a temporary pause between disasters. It will begin to feel like a tool you know how to protect, use, and rebuild. That is a deeper form of wealth than simply seeing a large number on a screen. It is knowing that progress can bend without breaking. It is realizing that money is no longer only something life takes from you. It is something you can direct. Once you understand that feeling safe is not only about having money, the next question becomes, where is the actual line between struggling and stable? Because bills being paid can mean you are current without meaning you are protected. That is what the next video breaks down. If this made you look at money differently, subscribe to Fiscal Sense because this channel breaks down the hidden money patterns that keep hardworking people stuck and the quiet shifts that help money finally become stability.